Hey
Very
everybody,
good.
welcome to our February COBE Entrepreneurs meeting. I'm joined here by a wide group of entrepreneurs in the COBE ecosystem, and I'll give it over to Abraham to make any announcements that he'd like to make to the group.
Hey, no. So thanks, Andrew. This is fantastic. Actually, just the second month, and we have, I think, we're just growing our community, isn't it? I saw that about 3 days ago, we had about 4 or 5 people join the entrepreneurs group once we announced that we're going to conduct this fundraising program. I'm hoping they'll join in soon, which will be fantastic. I think you should be on the lookout for people who are going to join as you kind of talk in. Andrew, that's a request from my side.
Mhm.
So to reintroduce Andrew to everybody, he's been a transformational leader. He's a serial entrepreneur with several exits. Uh, Generally, he backs bold ideas, which is why I think we saw him backing Subu already, kind of telling him, pushing him as to what he needs to do next. Other than this, he combines his visionary thinking with hands-on execution to lead high-performing teams towards success. That's one of his probably primary goals, right? He's a graduate of prestigious programs at Wharton and Berkeley, and he has a fantastic business acumen, guys. There's no doubt at all. We have been probably interacting for about 6 months now, and definitely he brings in a lot of things from several aspects of the business as he does generally, right? He's an active supporter of entrepreneurial innovation through his involvement with Wharton, the Angels Group, and also the COBE Entrepreneurs Club. And I'll hand it off to him to commence the session. So,
Okay, so this session is really about some basic do's and don'ts that I see. I do see a lot of pitches, about 20 a month. I talk to a lot of people, and there's some kind of red flags that pop up that you want to avoid. So I've come up with, as an angel investor, kind of a short list of rules. The very first rule is be real with investors and be real with yourself. If you're showing me a revenue ramp that says like 200,000, 1.5 million, 28 million, 3 billion, I'm not going to buy that. And so you need to be real about your projections, and you need to be real with what the product is. And also this includes listening to feedback from entrepreneurs, or rather from investors, because that's the most valuable feedback. All too often I see entrepreneurs, they'll get feedback and their immediate response is to kind of repel it and push it away. And actually the investor's really telling you like, hey, this is something I would like to see that would make me more interested in your idea. So think about that feedback and be real with yourself. Ideas are cheap, execution is expensive. Everybody's trying to make an MVP, most rather
minimum
an MVP, right? A proof of concept at the very beginning. I really want to stress the minimum in minimum viable products. Okay, you really want to step very lightly, work with ideas before you go into production. So I say ideas are cheap, execution is expensive. You need to think really hard about those ideas before you bring them into execution, because once you start executing, then you might have to go back and change things, or you might find the whole thing was wasted. Um, Show investors what you've got when you're taking off in that presentation. You really want to come off like a rocket ship. You want to generate excitement. You want it to be a really powerful presentation. So think of that. Forgive me, guys. I'm also managing the room here. So think of that as, did I just go back? I did. Sorry. So think of that when you're giving your presentation. You want to start really strong with a big question, like we just heard from a young man who is dealing with pet pain. And so a great conversation, a great start would be, hey, is your pet in pain? If your child was in pain, so you make that big moment that helps people understand. And that's what I say, show investors what you got, start off like a rocket ship. Uh, have a plan. It should be an amazing plan, truly amazing, right? Not something we thought up just last night before the presentation, or we kind of bumped it around with some people. What do I mean by that? A business model canvas. I don't know who here knows about business model canvas, but it's something they teach in a lot of the Berkeley programs. And this is a map that tells you like who's your customer going to be, who's your suppliers going to be, what are your marketing channels. So those, the more of a plan you have, and then definitely also a plan for how you're going to spend the money, the more obviously entrepreneur, whether angels will be enticed into funding. So really work hard on that plan. Really work around the corners of it, and make sure that you can answer tough questions about it. Again, I'm working the room here. So the next rule: never set a target that you can't exceed. And this goes into the revenue, the crazy hockey stick revenue ramp, right? I'm doing 200,000 this year. Next year is going to be 1,500,000. The next year is going to be 10 million. I won't really believe that. And then when you miss that target, you've really lost a lot of trust. So when you're laying out, listen, I was in software development for 30 years. I owned 3 tech companies. Do you know what the answer is about when the software is going to be done? It's done when it's done. You know what I mean? I mean, like you want it to be done by this date. You plan it. You should also add like 30% on for testing and QA, and then it's always going to be late. So you want to make sure that you don't promise delivery of product to customers or delivery of MVPs if you can't meet that deadline. Never set a target that you can't meet or exceed. Build a great team because you cannot do it alone. I've seen a lot of entrepreneurs that are new. They get into friction with one of their key partners, and all of a sudden the relationship blows up. As employees, we're used to having some leverage with our coworkers, and maybe there's a stopping point. Sometimes when you take those reins off, and let's say I'm the CEO of the company and my friend is going to be the chief science officer, uh, once I get into that CEO role, I kind of feel like I've got to be dominant. And that's not great. You really need to have the whole team on board. So watch out for those fractures and those breakups. They happen all the time in startups. I've even seen it with husband and wife couples where it causes a divorce. So make sure that you're paying attention to your team members and taking it easy on them, but also getting good execution. Work hard. Seriously, work hard and often. Doesn't that sound crazy to work hard? But a lot of folks, and I've met many entrepreneurs that think, okay, that's it. We raised the money. Woohoo. All right, we're good. And then I keep getting the same update month after month, quarter after quarter. Oh, we're still working on this licensing agreement. Oh, we're still working on this stuff. And I kind of get the feeling like, okay, you have, now this large sum of money. It doesn't really feel like you're working hard enough. And if you're going to be an entrepreneur, you need to reset the boundaries on your time, because it's going to be 80 hours to 100 hours a week. That's pretty standard if you're growing. Make good decisions with customer confirmations. Uh, the worst thing in the world you can do, at least in software, is to build a product that nobody wants. And how does that happen? You don't verify with your customer that you're building something that they want. Maybe the CEO has a big idea, and he is talking to his buddies at dinner, and they come back and the CEO is like, wow, we've got to do this right now. Me and my friend think it's awesome. Well, okay, have you taken that to the market? Have we validated with customers that they actually want this? Because every second and every moment of resources and time and energy that we're spending to move the company in one direction is moving it away from the right direction if we're not following customer feedback. Always validate with your customers. Those of you that are Scrum type folks that work in development, you know this. You don't do a waterfall project where you go on the dark side of the moon for 6 months and then come back with a completed product. You're typically doing small sprints and then validating with your customer, or internal or external. Hey, is this what you wanted? So I really have to hammer down to make sure that you're using customer feedback and customer confirmation to move forward on your product development and your services development. Number 9, a company also has to make money. Make money. Okay. So ideas are great. Coming up with this new thing is great, but you have to be able to demonstrate on paper and in real life that you are making money. Doesn't mean you have to be profitable. Okay, so there are many companies, Facebook, Google, all these big ones, they weren't profitable for years and years, but they demonstrated that they could make money. And that was what really got the big investors in there. So as long as you have that little money machine and you can prove that, hey, once we get this up to scale, we're really going to make money, then you'll get a lot of support from investors. But this is forgotten a lot. Where, for example, I had a company last year where the CEO was promising XYZ growth, and then she decided to turn around and get like some kind of ISO certification done. And I understood the need for her to do that, but I said, maybe you're distracting yourself from the core point, which is selling your product and making money, right? So don't give yourself like a distractive task. I feel like entrepreneurs a lot, making money and selling product is hard. So they'll like come up with another project that they can actually accomplish. And that's another huge mistake. You want to make sure that you're focused on your revenue and your margins, and that improving its scale. Ensure that the company financials are impeccable. An old saying in the stock market and in angel investing, and that is accounting errors equals sell. Okay, so you have no second chance on financials. I've been in the middle of the deal with somebody where I was going to write a very large check, and then I go looking through their financials, and they have all this money on the balance sheet that shouldn't be there. They were kind of flubbing up some capital reserves, and it immediately set the red flag, and that deal was done. I wasn't going to work with that person, because if I can't trust your financials, then really that's what we're buying, right? We're buying based on financials. In the software world or in subscription world, make sure that this includes that you are accounting for your revenue on a GAAP basis. What is that? It's a diluted basis. So for instance, if you're getting a subscription in June, you only get to count half of that revenue for this year. The other half gets counted into next year. That is GAAP accounting. Finally, produce results, not excuses. Nobody likes excuses, right? And so this is another thing that goes wrong in the second phase after you get the money. You don't produce the results that you promised. So we can kind of tie a bow on that. You don't want to set a target that you can't exceed, and you want to produce those results. Look, things go wrong. Everybody understands that. Nothing ever gets done in the time frame you want to get it done. Everybody understands that. But you should remember that the investors are putting up a lot of money. They want to see results, and excuses are tiresome for them. So when you come around for another round of funding, a second round, you may have problems. So I talked about taking off like a rocket in your presentation, right? Make your points quickly and clearly. Avoid word-heavy slides in your pitch deck. Hey guys, let's all just stop for 1 second, okay? What are you doing right now? You're reading my slide deck, right? And that's why I actually, hang on a second, I have some traffic coming in. That's why I actually don't like to put a lot of words on my slide deck, because the very first thing the audience does is read the slide deck, and they're now not listening to you. It was a little tricky there. So demonstrate your value for customers early. When you're making that statement, you want to have a really clear value proposition right in the beginning. It's like a story or a movie that we're watching on TV, where it starts out with that action scene, and then they kind of go back and show you, 1 week later. I don't know if any of you guys watch White Lotus, but White Lotus, the show on HBO, just did that. They start with this shooting scene and then they kind of go back and tell you what happened. Telling that so that really powerful part of your pitch in the beginning is going to get interest, and people will pay more attention. Make sure that you define and validate your total addressable market, your service addressable market, and your service. I forgot what song is.
Obtainable market.
Say again.
Obtainable market.
Yeah, service attainable market. This is a critical thing that, believe it or not, people don't think about, right? And don't be crazy with it. Don't say there's 85 billion people that will need my product. One thing I saw that was very successful, and it actually was a pet company. It was a rather a pet grooming service. Is rather than give, you could say, well, there's 53 million pets in the United States, right? And that's our market. But what they did is they actually went regionally. They said, we are going to start in these regions, and this is the TAM, SAM, and SOM for these regions. Then we are looking at these other regions where there's higher concentrations of pets. And so we're going to roll out very, very wisely. I thought they were doing two things really well. They were setting expectations. They were not giving a kind of a blown out, fluffy number. And it really made the far end number when they said, here we are at year 3 at full scale. Now I actually believed their big TAM and their big SAM and their big SOM because they showed me the path that they're going to get there. So, entrepreneurs have a tendency to exaggerate a lot, and the less you do that, the better you'll be. So how will you create a 5x investor return? This is the truth. So if I did probably 12 deals last year, and I'm very sure 2 of them are going to go to dust before the end of this year, and 2 of them are doing extremely well. And so because of those odds, I need a 5x return on my investment. If I'm going to give you $1 million, I'm going to need 5 million back in about 4 years. Okay. Now we can go into IRR and MOI, money multiple on invested capital, and things like that. But essentially, people are looking for that 5x return in about a 5-year time frame. Just admitting somebody else. Don't forget to generate excitement for your idea. You don't want to be like a low talker or avoiding contact. You really want to blow that up. I mean, look, I've got a picture of a rocket ship. That should be you giving your presentation. Bang! Look at this. You can't live without this. You have to get into this deal. And then managing investor interest in closing deals. Look, this is the hardest part. Investors will sit on the call, they'll listen to you, they'll think, this is good or maybe not. But I'm going to tell you, it's the squeaky wheel that gets the oil. It's the people that call me back or text me. I mean, I've had some deals I didn't even really want to do, but the guy kept bugging me. So I finally said, okay, well, we'll do it. So, managing those investors, contacting them, asking them great questions, like, hey, what did you think could be improved? What did you think about this part? And then when they give you an answer, you actually want to listen and take notes and maybe take that under advisement. So valuations and investment structure. This is a very big deal with some investors. So there's different types of structures that you can have: safe notes, convertible notes, equity, where we're actually selling common and preferred stock in the company. You should also be mindful of specific investor rights. I believe Scott said he was going to Berkeley for the VC program. You're going to meet Jerry, who's a real character, and he's going to pound rights into your head. Every single right that you give away, a preemptive right, a most favored nation status, all of this actually has a value to it. So as you're negotiating these things, know that they're not just things that you just want to give away. You want to be mindful of that, and we'll talk a little more about that in just a second. Pardon me 1 second. On our next slide. So safe notes are the least favorable. They're very, very common, especially in California, but they are the least favorable structure of angel investors because you really have no leverage. You're not even on the balance sheet. It's not considered debt. It's literally taking a piece of paper for maybe in the future a company having some valuation. In fact, one of the positives about safe notes is you don't have to negotiate a valuation. What's common in the Y Combinator safe note is basically a 20% discount on whatever the next round is. That's very common. What's uncommon is anything more than that, like 30%. And what's also uncommon is any kind of rights in a safe note because a safe note essentially has no rights. Entrepreneurs should be aware that the American Angel Association actually writes large articles about not investing in safe notes. I happen to know quite a few people and firms that will not invest in safe notes, but I also see quite a few people raise a lot of capital with the safe note. It's obviously the best thing for you as the entrepreneur, but then conversely, not the best thing for the investor. Convertible notes are very popular, usually in a later stage. So, a convertible note is going to convert into stock at a certain discount. Now, these discounts can range all over the place. And in a convertible note, typically you have a valuation cap. They are typically mutually exclusive, meaning you don't get the cap plus the discount. You get the cap or the discount. Just something for you guys to know what is normal in that area in case an investor says, no, I want the cap and the discount. No, you usually get one or the other. But hey, in convertible notes, you're going to spend more money on your lawyer, on your legal fees. Each deal I do, I spend about $10,000 and I'm just receiving the paperwork. So that paperwork getting created and then getting negotiated. So you should think about that too. If you're going to move off of safe notes and you're going to start negotiating with people in convertible notes, expect to spend $5,000 to $10,000 on your lawyer reviewing the back and forth with the investor. Equity, common, and preferred. This is typically very late stage. I have seen it happen in the seed stage. A lot of times for me, when I see people raising, sorry, when I see people raising money early on with equity, it kind of raises an eyebrow. It looks a little to me like lack of financial sophistication. If you're already past your Series A, it's totally fine. But in the seed stage, it's very uncommon to have common and preferred. Of course, the investor is going to want preferred, and they're going to want participating preferred, which Jerry will teach you about next week, Scott. And participating preferred means I get paid first. So if the company goes belly up, who gets paid first, right? And every investor is going to want that right. So as new investors come on later in later rounds, they're going to want to be ahead of everybody that was before you. This brings up another conversation about offering too many rights to people. So if you're in a very early deal and you kind of give away the farm, you give them most favored nation status, preemptive rights, a monthly proctology exam report, all of these things that they may want. Uh, Everybody after that guy is going to want the same thing. So you've kind of put yourself in a stitch. So be careful in the beginning of granting too many favorable terms. I know it's a hard time. You're trying to raise that first bit of capital, but everything that you give everybody in the beginning, you're going to have to give more away in the end. So be cognizant of that, keeping those rights. Now, I use that to my advantage a lot when I'm early in a deal and I'm going to put in a big check. I'm going to want a lot of rights. And I get that feedback a lot. Well, hey, if I do this for you, people are going to come along later. And I tell them, well, they didn't come in now with a check. They came in later with a check. So that's what you can tell them. I don't know how well that shtick goes. I know that most investors are going to want what anybody else had in the deal before. And my slides are flipping around. Finally, your valuation metrics. Look, guys, don't be crazy. Don't pick something off the top of your head. Everybody will say, oh, it's a 20 million valuation and I'm raising $2 million. Okay, how did you get to your 20 million valuation? It's a very, all of us have watched Shark Tank and saw the people coming in. Hey, I'm selling 5% of my company for $5 million. And everybody groans and rolls their eyes. And why is that? Because the odds are already really heavily against you. So uh, if you're going to make a change, valuation, I think, is the place to do it, because it's the one play. In other words, if you're going to give up something to an investor, and remember, this does not apply in a safe note, or rarely applies in a safe note. It typically applies in convertible notes. You want it. That's the valuation, is where you can play around a little bit to give a better deal without giving rights. And the reason for that is as the company progresses, the valuation can be rejustified. But your valuation has to be justifiable and realistic. Believe me, we all know it if a number was just picked out of the air. Similarly with those crazy hockey stick charts that look like people are just picking out of the air. Very first thing someone would ask you, who's going to put in 100,000 or 300,000, they're going to say, "How did you get there? How did you get to your valuation? Why? If you had a round last time where you were worth 15 million and now all of a sudden you want 30." And I've literally seen this over a 6 month period. And I'll say to the folks, "Hey, what made you worth double in the last month? What happened?" Right? And they might say, "Well, we finished our MVP." And I said, "Okay, well, that you're not generating any revenue, like." So that's another thing, is you want to be realistic with your valuation metrics. Remember, a lot of times with investors, they're looking for that one or two red flags. And this valuations being crazy high or unrealistic is a huge red flag. Finally, ask yourself this question: would you invest? Really? If you're looking at this deal, put the investor's shoes on for a moment, and you're looking at this maybe for your mom or your father, for your kids in a trust fund. Would you invest in this idea? And so if it's not passing that test, if you really would, and essentially you are investing. A lot of people say, "Well, I'm investing my time. It's a time equity thing." Really, nobody gives any value to time. They want to see hard dollars. But remember that's the litmus test. Would you invest? Would your mom and dad invest? Would you take mom and dad's money and put it in this venture? That's a good test as to whether or not you have something that's attractive for an investor. We're getting to the end here. Closing the deal. Okay. Now you've gotten through the pitches. You've gotten through the being ignored 300 times when you called the guy. On the 400th time, you pinged him on LinkedIn and he said, "Oh, sure, I forgot all about you and let's do the deal," right? You must have a lawyer on board to review and approve any investment proposals or agreements. I have a favorite saying. You need, there's three things that you spend money on in life: toilet paper, soap, and lawyers. And that's because you need all three to keep you clean. Listen to me now. Don't do a deal without a lawyer. One little tiny tick in some language, one little tiny change can have a massive impact. I've had it happen to me. I have a great lawyer and I've breezed through things. I even use Chat GPT to look through it, which is a great thing to do. But you cannot skip that and save that money. You really need to have a lawyer on board when you're signing these different proposals or even reviewing them. I remember when I sold my first company, I got an offer letter, which just looked like a friendly letter, but it was a legal document, my lawyer explained to me. And by just saying yes, I was accepting a ton of terms that I didn't even really realize because it was in this nice letter format, right? So again, even during negotiation, you want to make sure you have a lawyer. Investor rights have value. We talked about that. Negotiate for rights as if each one has a monetary value. So preemptive rights, information rights, these are pretty basic. Information rights you should offer. Preemptive rights, that allows somebody to come in later and buy at their current valuation before anybody else buys. And that can cause problems with other investors. Most favored nation status. Sounds great, doesn't it? Well, it means that if I get most favored nation or MFN, then I get any terms that anybody else gets in the future that are better than mine. So I do that typically again with early deals with a lot of money. And guess what? All the investors that come after me, guess what they're asking the entrepreneur for? They want MFN rights too, right? Because I got it, and why did I get it, right? So um, you really have to be aware of those investor rights and understand each one has a value. Can you tolerate the deal terms? Can you live with the investor rights if you get more money? So there's always a give and take, right? And one of the things I do to get a little more rights is I'll offer more money, and that's very attractive to the CEO because it's one less check they're going to have to raise. So a lot of times I'll say, well, listen, if I can get MFN on this, I will invest, twice as much money. And so, can you tolerate those deal terms? Um, Even after your lawyer passes off on this deal, sit with that deal for a minute. You're not in a race. Anybody who's pushing you is not doing you any favors. Sit with that deal overnight and really think about it, because once you sign that deal, you've got a partner. That partner's an investor, and they're going to have rights, and those rights might lead them to sue you if things go wrong. So think about that. The deal isn't done until the check clears. Okay, make sure you close the deal and get paid. How many times I work in the Wharton Alumni Angels a lot, and we see a lot of deals every month. And people will come in and they'll make a commitment. They'll go on the deal portal and say, I'm going to invest X amount of dollars. And then we get down the road, we they've met the minimum, so we're going to go close the deal. And then all of a sudden people start falling out, or they don't fall out and they just never respond. Okay. So there is no such thing as a bird in the hand when you're raising funds. You want to push that deal to close, and you want to make sure you get the check and the check clears. Okay. It's a big part. I think people think, well, the guy told me, we signed the paperwork, everything looks great, everything but the money didn't show up, right? So the money showing up is a big deal, and sometimes you are going to have to push to get paid. Do what you said you would do. This is what we call the what do they call? I can't remember, the guardian personality profile in Myers-Briggs. The guardian personality does what they say they're going to do. If I promise you I'm going to do X, Y, Z, I'm going to do exactly X, Y, Z. Execute and deliver results, no changes and no BS. Now that doesn't mean you can't pivot, right? If you every business that you see that's huge right now pivoted at some point. Facebook pivoted from being something for colleges into something national. YouTube started out as a dating site, believe it or not. And then the CEO recorded a video of the elephant at the zoo, and that got more reactions than anything. And he thought, wow, we could just have video. That would be great. So YouTube's a great pivot story. But if you're going to pivot, you really better have a great story, because I've had some entrepreneurs where I've funded them. They go down the line, and then all of a sudden their thing's not going to work out. So they're just going to do something completely different. And that wasn't what we agreed on, right? We agreed on you were going to execute this plan, not some other plan that you just came up with, right? So keep that in mind. The more you can be on target and deliver results, you're going to have an easy time raising capital the second time around. Remember, capital isn't a one-stroke thing. You're going to need to raise capital a lot. Now, I've talked about this next point before, but it's really, really important. Keep impeccable financials and update investors regularly. The people that do this, even if they have bad news, I'm still much more open to them because they are telling me the bad news, right? So they're maybe asking for my help, or they're telling me the good news. But I cannot stress enough. Does anybody here familiar with SMCI Supermicro? Their stock just got hammered like 80% because they had an accounting error. And EY said, we're not going to sign off on these financials. So they just went and found another firm with a little less scruples, and they signed off. I shouldn't say that. they found another firm that agreed that the financials were acceptable. And so then the stock jumps. But my point is accounting errors equals sell. I always use a professional accounting firm when I'm doing this. And again, if you're doing anything with subscriptions, make sure you're accounting for the revenue in GAAP. Um, Finally, I really want to get this out to entrepreneurs who are the leadership or the CEO. Always be raising capital. This is the CEO's number one job. Yes, number one. Yes, you need to execute on the idea. Yes, there's a lot of moving parts. Oh my gosh, it's so overwhelming. But the minute you take your eye off the funding ball, you're going to run into a problem. So I see this with some companies in the biotech space where they say, well, we're going to take a break from raising capital because we're going to do some more work in the lab. And their thought is that's going to increase their valuation. I just had a talk with the CEO over this and I said, look, you can't wait like that. If your burn rate is X a month and you have only Y amount of money, you're out of money in 8 months. So you telling me you want to spend 6 months in the lab, come back with 2 months runway and try to raise capital now, right? That's just crazy talk. So always be closing, always be raising that capital. Explain it to your team. This is my number one job. If you have execution responsibilities that don't allow you to do that, hire somebody else. Hire a COO because you need to be raising capital all the time. Okay, finally, I'm just opening up for questions and answers. Assume I don't know anything that you didn't tell me. Assume that I will learn nothing from your silence. Talk to me. I'm listening and learning from you. And that is the end of my presentation.